Okay, we're going to call the meeting to order, and we will begin with a prayer and a pledge of allegiance. Dr. Whaley normally leads it. Is there anyone here in the audience or on the council who would like to lead it? Okay, then I will. If you will stand, please. We'll say the prayer. Dear Heavenly Father, thank you for this beautiful day. Thank you for this beautiful city, this beautiful country that we live in. Pray, God, that you bring strength to the council. Always guide this council, future council, with wisdom and knowledge and a fair heart to all in the community. Please allow them to see the good and the bad and to differentiate between the two. Thank you, God, for this opportunity to serve you. Amen.
Amen.
Everyone's turn around and let's say the prayer. Or the pledge.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
The purpose of this meeting is a public hearing. We have two things. One is a work session for the budget. Our city administrator has a prepared budget before you, and hopefully you will have a chance to ask any questions you might need at this point. We're also for a public hearing for the reading and consideration of adoption of agreement amending the City of Blue Ridge's Georgia Municipal Employees Benefit System. What we would like to do is give you the opportunity to ask questions during the presentation on that. So I believe maybe it would probably be okay if we at this point have the public hearing after you go over it. Would you like to do that or have the public hearing?
Mayor, on the retirement amendment, we don't need a public hearing
Okay.
on that. We just need a first reading.
Perfect.
I believe council that and council-elect. Good afternoon, everybody. Sorry, I'm jumping right in. I just got here a few minutes ago. Still a little road weary. You should have a copy of the ordinance. Your retirement plan is adopted as an ordinance, and I'm going to get to that in the slides if y'all will bear with me for just a moment. In your email this afternoon, Jennifer is sending to you the actuarial study that was conducted for this. I know several of you had asked about that. So those documents will be sent to you this afternoon as well. So if you guys don't mind, just holding your questions, we'll cover that as we get through the process.
And Mandy, can you speak a little bit? Yeah.
I don't know if it's on. It is on? Okay.
Okay.
It's on.
Okay.
I will try.
Perfect. Thank you.
Yes, ma'am. Would you like me to move into the budget discussion?
Please.
Mayor?
So let's go ahead and move
Okay.
forward with that. Yes.
Thank you. Okay. So, good afternoon, everybody. I have prepared some slides and some conversation points for you on the proposed fiscal year 26 budget. Just a reminder of where we started. We started this process, our time together in this role at the end of April of this year. And it has been quite a journey, as you may recall. At that time, it was end of April, almost May of 2025. And we were dealing with a lack of staffing in our finance department and bank reconciliations that had not been performed since September of 2023. It was also just a few weeks after that the financial consultant that the city had engaged previously to assist with audit preparation, given that at that point our fiscal year audits for both 23 and 24 were tardy being filed to the state, that particular consultant resigned his position with us. So we were starting from a very challenging spot in the sand, so to speak. Since that time, we have encountered some additional challenges that have all affected this process. The GFA construction draws, vacancies in the finance department, some payables and purchasing card issues, our fiscal year 25 budget deficiencies, which I'll talk about in just a minute, and the change in our bank account. So, as I said to you at a previous discussion, the proposal before you is not as solid a budget as I would prefer to present to you, and I'm going to continue to recommend to you and remind you that you monitor anything that you adopt as a fiscal year 26 budget throughout the fiscal year for both performance and fiscal issues, and that you continue to revise as we learn more. Where we are in that process, as you know, the fiscal year 23 audit has been submitted to the state. We're happy to say that it is currently under review by the various agencies that have a part to play in that. To the best of my knowledge, we've not received any feedback at this time, but it has also been submitted to Bank of America, which is our purchasing card program. I don't know that we have talked about this as of yet, but I think it's in February, the city sort of credit, if you will. Most of us on a personal level, we're kind of accustomed to, we get a credit card, and as long as we stay in compliance with our payments, we keep that credit card. But on the municipal level, you have to reapply every so often, and our time to reapply is actually in February of 2026. And so we have been working with Bank of America, who operates and manages that purchasing program. Now, a purchasing card program that municipalities have is not like a credit card in the sense that you can run a balance, okay? It's more like a charge card. If you have like an American Express card, you have to pay it off, every month. And so every so often it'll come up for review. We're up for review in February of 26. And it was of concern to them that our audits had not been submitted. And we typically max out. We have a very low limit. Our limit is only $15,000 per month, which is an incredibly low limit for a municipality. And so we tend to max that limit out even before the month is over. And so we've been working with them to get the documents to them that they need in preparation for that review. Fiscal year 24 has actually finally begun what we would call the audit preparation stage. That particular preparation stage, the previous preparation, we had to start with cash reconciliations. As I said, those bank accounts had not been reconciled. But to make it even more challenging, we had a number of entries for fiscal year 24 that had not been made. We did not have a finance staff during that time to speak of, if you guys remember. And then we had some challenges with how some entries had been made by a consultant that had been engaged by the city. And so all of that had to be caught up, unraveled, disentangled, and then booked again. And that took an incredible amount of time. But that thankfully, I'm proud to report, has been finished. And so now that we're what we call the cash portion of the work has been completed, we're now moving into actual, what we consider the audit preparation stage for fiscal year 24. Okay, that's moving forward. And if you all remember, this is the year also that we've learned that we have triggered our thresholds for federal funding and will be required to perform a single audit for those grant and loan funds that are backed by federal dollars, in addition to our operations fund. But that is moving forward. It is in the hands of JAT and Welch Walker CPAs, our external auditor. They're prepared to take that over as soon as it is submitted to them. Fiscal year 25, we are the staff is working on that. As you may remember, we sort of had this tiered approach. The auditor was in one fiscal year, the financial consultant was in a different fiscal year, the staff was in a third fiscal year, and then I was working on a fourth fiscal year for you. So we have taken a multi-year approach, which is almost unheard of and how aggressive it is, to try to get as much of this work done for you as quickly as possible. The staff, your two people in your finance department, are working daily to try to maintain the day-to-day accounts payable, payroll, those sorts of things. But they are also trying to back up and kind of do the books, if you will, for fiscal year 25. Because as you remember, we started this fiscal year, which was on January 1st, without a finance department being staffed. So we weren't booking transactions as they were happening. And so they are working in both of those areas every day. They are going back to book expenditures and revenues from the beginning of the fiscal year, while we're also simultaneously trying to keep the day-to-day payables, payrolls, collections, balance, all those sorts of things are happening at the same time. Assume your fiscal year for 25 will close on midnight of 12/31, so that's just a few days away. And we literally will have to stop daily operations at that point and start running audit reports for fiscal year 25. There's a unique feature in our particular software system that if we do not run those reports at that moment in time, at close of business on 12/31, we can't get accurate reports at a later date. You would think that you could go in at any point in the future and just put 12/31/25 as your report date and it would pop out an accurate report. We wish it did. We have learned the hard way that it does not. And so there will be several of us here on 12/31/25 at the end of the business day running those necessary reports so that your financial consultants and auditors will have those and they will be accurate on that day and time to close that fiscal year out. Also on that day, the auditor will be on site to begin the inventory portion of the 25 audit for our water supplies and inventories and things of that nature. So there is a lot happening behind the scenes in each of the fiscal years that the city has some outstanding work in. And then where we are today is to discuss a proposal for fiscal year 26. Moving forward, once we work through the work session issues, the budget will go to the council for a second reading, at which point hopefully it will be adopted. Once it is adopted, then we have to begin the implementation. There's really two huge things that have to begin with implementation. Number one is it has to be entered. What you adopted has to be entered into the financial system. I mentioned this to you at your previous work session, but it bears repeating. There were two huge challenges with the fiscal year 25 budget that was adopted. Number one, it was adopted without any revenues, which is non-compliant, but also very challenging. And so number two, it was not accurately entered into the software system. And that's been one of the reasons why you guys could not receive budget reports on any kind of regular basis. And so once this fiscal year budget is adopted, it will need to be accurately entered into the software system so we can begin tracking it, okay? And then of course we'll need to make a proper record of it in the archives of City Hall. The second thing that we're trying to do for you by January 1st is actually implement the purchasing module. You may remember that we procure the purchasing module that actually talks to your financial system and it integrates with your financial system. We encountered some challenges with being able to use it on city facilities outside of this building because of how our IT system was networked or not networked. So we have tried to work through those challenges, get that handled. We have a meeting next week with the IT folks to make sure. I think that's being completed. We're just gonna dot those I's and cross those T's. Train our team on how to use that. We began some of the training, but we wanna finalize that. And then hopefully we'll be able to implement that on January 1st with the 26 budget. So from day one, your expenditure request, your purchase request will be entered into that system as a requisition request, a request to make a purchase. They will be properly coded, which we'll talk about as we move forward today, and then move up the chain for the proper approval levels. And once they're approved, then they will be encumbered. So moving forward, as that is implemented, your management teams and the elected officials will be able to receive monthly or quarterly budget reports that will show you an accurate budget as it was adopted, revenues year to date, expenditures year to date, and also what we call encumbrances year to date. Encumbrances meaning we have approved that purchase to be made, we know those funds have been committed, but we haven't yet expended them, meaning we haven't cut the check for them. But you'll have more real-time and accurate information in 26. So all that's happening as we speak and moving into the final days of this fiscal year. This is not working great. Okay, fund structure. We've talked about this before, but it is different. So municipal accounting, local government accounting is a very different animal than private enterprise accounting. And one of the things that makes it very different is that we are mandated by law and regulation to keep what I would call different pots of monies. Funds, F-U-N-D-S, is what the Department of Community Affairs and the Uniform Charts of Account calls those different pots of monies. And the City of Blue Ridge has really 3 pots, and we're gonna go over all of those today. Your government funds, which is primarily your general fund, your enterprise fund, which is primarily your proprietary fund, your water sewer fund, and also your special revenue funds, which are basically funds that we keep custody of for restricted reasons. And we're going to talk about each of those as we move forward today. This is your general year. I wanted to give you a performance on the fiscal year 25 year to date, just as we have them. And guys, I'm just hitting the highlights, but you have these also. You have a document this afternoon that looks like this. This includes for you the specifics for your fiscal year 23 numbers taken from your audit, your fiscal year 25 that we have year to date, any fiscal year 25 budgets that were adopted in that and your proposed fiscal year 26, and this is where I'm taking these particular numbers from. These are your year-to-date revenues for fiscal year 2025, which is the fiscal year that we're in now. These are as accurate as we can make them through October 31st of 2025. Again, just to remind you, your fiscal year actually is a calendar year. That's not always the case at the local government level, but yours is. And this one is a little challenging because, as I mentioned, there were no revenues adopted formally in the 2025 budget that went through council. But I did want to give you a breakdown of your revenues year to date, and you'll see that as booked, we've collected about $3.4 million in the general fund. Now, I do want to give you a little asterisk by that number. Remember, I told you that we're still working on the 2025 books. We're still going back and making sure that all the revenues that came in were properly accounted for in our bookkeeping and that they were properly coded. One of the regulations I just mentioned to you is that we have to keep monies in a fund, F-U-N-D, and also that we have to properly code those monies, both revenues and expenditures, by something called the Uniform Chart of Accounts. And every number, all of those account numbers have very particular meanings. Now, we operate like many, many cities and counties do, to a large extent, off what we would call a pooled cash operating account. So what happens is at any given moment or day of the week, multiple monies may be coming into a particular checking account for the city that really serves as a pooled operating account. And they've been coming in since January 1st, and they're all coming in. Well, what the team is doing right now and have been working very diligently on for the last few months now is actually going into that bank account and seeing what each of those revenues and expenditures are, and this particular slide's on the revenues, and then identifying, well, what is this revenue? What is the particular, what fund or pot of money does it have to be credited to? What chart of account number does it have to be identified by? And what day do we have to book it, okay? So I will tell you that we are not current or up to 10/31/2025 on identifying and booking all of those revenues to that extent. So we may actually have more revenue in our receipts for the general fund than that figure would represent. But that's what we have been able to book and track and properly code on the revenues for fiscal year 25 year to date. The next slide will show you the proposed revenues for fiscal year 2026. The Georgia statutes require that cities and counties within the state adopt a balanced general fund budget for each fiscal year, and that it balance at the department level, okay? And your general fund services are those things that primarily are represented out of this building for the city of Blue Ridge. It's your body, the governing body, mayor and council, for legislative activities. It's any city administrator or executive management staff that you may have. It's your finance staff and department, your city clerk's office, anything that comes out of there. Your planning, zoning, permitting, taxes departments are all funded within the general fund. Parks, streets, public works, police department. If you have a contract, and you do, for fire services, all of that comes out of your general fund. So what I wanted to show you with this slide are the proposed fiscal year 2026 revenues that are in the document for your consideration this year. Because we were able to get, since the last time we talked, we were able to get a little more data booked. The last time we talked, we only had data through September 30th. Now we have a little more data up to October 31st. So I was able to increase some projections for your intangible tax, your real estate transfer tax, your local option sales tax, and beverage tax. But I remain very conservative in your revenue projections for fiscal year 26. Now, what I don't have are your audited or even a trial balance revenue number for revenues for fiscal year 24. As we talked about, the financial consultant has just recently finished those cash reconciliations. They're not all where they need to be coded as of yet, so I have no data to help guide our processes from fiscal year 24. We just talked about the challenges in the data for the year-to-date revenues for fiscal year '25. So the most accurate and timely data that we have is actually the audited data that just came to us a few weeks ago for fiscal year '23. So what I have attempted to do in your revenue projections for the general fund for fiscal year '26 is simply make sure that those revenues seem to stay in line with what we can look at from '22 and '23 and year-to-date '25, and make sure that based on what I know of your community and your city and that historical information that we do have, that the '26 revenues seem reasonable in light of the information that we do have. And I have stayed on the very conservative side of that. What I did not include as revenues in the general fund for fiscal year '26 are any grant revenues. Okay, so historically you've had grant revenues, things like your local maintenance improvement grant, your LMIG grant for transportation improvements. You've sometimes had a FEMA grant or other kind of state governmental grants that have come down for various activities that were coded to your general fund and accurately coded to your general fund. But because of our current situation, I felt it was the better approach to look at non-grant revenues for planning purposes for fiscal year '26. As that situation continues to improve and those opportunities may open back up for Blue Ridge, again, that's an opportunity for you to revisit your revenues. But I did not want you to make any expenditure decisions based on revenues that we could not feel very confident about, okay? The other thing that I did not program as a revenue for you in 2026's proposal is what we call a fund balance transfer, okay? A fund balance transfer is essentially where we take funds from our reserves, our fund balance, our savings account for that pot of money, and we plug it in as a revenue that can be used to cover expenditures in that fiscal year. It appears to me that in fiscal year '25, the year we're sitting in right now, that we anticipated at least an $800,000 transfer from the reserve account, the fund balance, to fund expenditures for the current fiscal year. I did not do that in these projections. You could do that at some point in the future if you wanted to, but again, I wanted to see what revenues without borrowing or taking from our reserve account could we count on from a very conservative projection base for fiscal year '26, and we're going to talk more about your fund balance in just a few minutes. And then those are broken down for you in your particular handout. There are a couple of revenues that I'm a little concerned about, not worried, just noted in my reviews that were down year to date for fiscal year '25. Those included the liquor license tax, the beverage license, and the downtown shuttle. Now, why are some of our licensing and tax dollars down? I don't know anything in the local economy that would have caused those to be on the decline. So I'm suspecting that they're not actually down, that they're just not coded yet or coded correctly yet. But I've put that on my list of things to continue to monitor. And I think my understanding is that the parking shuttle just was not operating for a period of time, and so that would explain that particular decline. I'm going to skip that for just a minute. General fund expenditures year to date, we have again, because we did have a few more, a bit more information, another 30 days worth of information. Those have been updated for you in your packet for today. And again, just to remind you, the most timely and accurate data we have for general fund expenditures is from our '23 audit that we received just a few weeks ago. We've covered what's going on with '24 and '25. And so for your general fund expenditures broken down by both department and line item, I have again just tried to remain very conservative and very consistent in your projections. A few changes that I did make in the general fund for '26 moving forward is that I eliminated a tax administrator position from the funding. The reason that was funded, that appeared to be funded to me in this current year, fiscal year '25, the reason I did that is that I'm not confident that the volume of work actually supports the need for that particular position. So I wanted to leave that unfunded at this moment, and we'll talk about some other situations involving that as we move forward. I did move $39,000 that has been budgeted in this fiscal year for downtown holiday lights. That was in the Parks Department within the general fund. I moved that to the hotel motel tax fund. After talking to the auditor, that's a legitimate, and lawful use of the hotel motel tax dollars. And anything as a best practice, any expenditure that you can take off of your general fund, you want to do so. Why? Because your general fund is what is supported primarily by your tax dollars. That's where occupational tax certificates and alcohol tax and business tax and all of those sorts of things are, those revenues are going to support those general fund departments. And so, you know, you want to make sure that where you're relying on your taxpayers for revenues, that you're doing so for those generally available services that they're benefiting from, and that there are no other lawful revenues that could be put to that, so you can try to keep your property taxes as low as possible. So I did move those expenditures as well as some smaller expenditures for like cleaning supplies for the downtown restrooms and cleaning supplies for the farmers market. Tacey and I reviewed those, and we also moved those to the hotel motel tax fund. Of course, I eliminated the elections expense. We had to have an elections budget for fiscal year 25. It was an election year. There are no planned elections for 26, so I did not put any funds to that. I did increase the training for the council. We have new members coming in to the governing body. We had a very, very small, almost negligible training budget for the elected officials in the 25 budget, so I did increase the training and travel budgets for the governing body. And I eliminated, this is really important, I eliminated all capital project funding from the general fund. Okay, so your general fund projections for expenditures for fiscal year 26 is operations only. Now, why did I do that? I did that because we're going to talk more about it in just a minute when I show you your special revenue funds. But again, I wanted to get a baseline for you all. What does it take to operate day-to-day operations from a revenue and expenditure perspective, okay? Capital projects are those things that are going to have some sort of multi-year lifespan on them, and they're typically going to cost different places put their policy level at a different price point. Some as low as $5,000, some $25,000 or more, some $100,000 or more. Okay, but those are those kind of investment pieces. So think about fleet, cars and trucks and equipment, IT infrastructure. But it's also the things that we all need, like paving the roads and streets and patching potholes and street signs and improving playground equipment and park facilities, and stormwater is a big one here. Those capital projects have been funded previously out of your general fund primarily, and I took those out this time. Again, to get you a baseline of what does it take to operate the day-to-day operations without the capital projects for the general fund. And then I'm gonna show you why that's really important in just a minute. As we all know, personnel is the largest part of the general fund budget. It takes talented staff to keep everything operating and services going out to our citizens. So this is included in your handout as well. This is a position control sheet that is included in your general fund budget for consideration for adoption in the 26 budget. What it attempts to do is identify every position in the general fund, how many of those positions this particular budget would fund, full-time or part-time, and then I will also have for you a compensation plan. You guys formally had adopted a pay plan. Most people would call it a pay plan. If my position is patrol officer, I qualify to make somewhere between X number of dollars per hour and Y dollars per hour, and that's a position control. I did have candidly some challenges in working through the personnel and the funding for the personnel in your 25 budget. What was listed on the budget was not necessarily consistent with what was in the payroll program, was not consistent with what was in the finance program. And so I've tried to unravel that as best I could, and this chart and the funding that's proposed in the salary and wages line item for each of the departments attempts to unravel that for you and give guidance. This is one of the reasons why this particular control is so important, is because when you are asked, or your management team is asked, can we hire an additional accountant, or fill in the blank. We need a new receptionist, whatever that position is. How will you know whether you funded for those positions if you do not have some kind of position control adopted within your budget? And there are staff, and I mentioned this to you later in the presentation, there are departments right now within the general fund that are telling me that they are that they are understaffed. They need to hire additional folks. Well, without this kind of tool, how would I know that I could financially responsibly hire those additional folks? Or at what pay rate would we hire those folks? So I've attempted to create this for you for fiscal year 26, include it in your budget, and hopefully you'll be able to use it moving forward. In addition to compensation packages, or your base wage and salaries for your employees, another big expense is employee benefits. Under your group insurance line, that line actually includes 7 different benefits that are paid to employees by the city as part of their overall compensation package. So when you guys go through the different departments and you see a big number for group insurance, I wanted you to know what all was included within that line, okay? There are included in your wage, in your salary line items for each of the general fund as well as the enterprise departments for the proposal, a merit increase of up to 3%. I want to talk a little bit about what is a merit increase versus what is a COLA, or a cost of living adjustment. A cost of living adjustment is intended to keep a particular wage point up to date with the inflationary and other market demands that's happening in our economy nationally and locally. A position, people are priceless. A position has a price point, okay? So if my job is X, then there's a competitive market rate for that position. X pays this amount of money per hour, per week, per year. And if inflation is rising because cost of living is going up, but I keep it here, I keep my wage that I'm offering that position at here, then I'm no longer competitive in the workforce. I'm no longer competitive in the marketplace. And I'm going to risk losing all the investment I have made in talented folks, right? A merit increase is actually awarded to an employee based off of a formal performance review. It is very typical in local government and the business world that every year wages are looked at for both a COLA, cost of living adjustment, or our wages staying competitive and up to speed with the inflationary and other market demands, but also for merit increases, meaning we are awarding those employees who are performing above minimum expectations. And it's pretty typical in my experience that at the local government level, that's for an up to 3% merit increase. Now, I'm being very careful when I say up to. Some employees may be reviewed, and the performance review should be a very standardized process with supervisors and department directors. They may be reviewed, and they may be based on their review and the formula that speaks to that review. They may not qualify for a merit increase. Or they may qualify for a merit increase of 0.5% or 1% or 1.5%, okay? And that just depends, again, that is intended to reward performance. This particular proposal for expenditures in fiscal year 26 does not contemplate a COLA. I'll tell you why in a moment. It does contemplate, however, an up to 3% merit increase based on performance review. You'll notice the next point I have on the slide is that I calculated that at a 1.5% midpoint. That's just a best practice that we use. Not everybody's gonna merit a 3, not everybody's gonna merit a 0. Typically, if we calculate and fund at a 1.5, we'll typically stay within our budget. And as you see on that, for the general fund, that was just over $23,000 in additional expenditures for 26. Now, one of the benefits that you guys offer to your team is a retirement package, and this goes to the first reading on the retirement amendment that we were talking about just a few minutes ago. I've had a lot of questions about, well, how is retirement for the city handled? You have what we would traditionally call a pension plan or a defined benefit plan here at the city, and it is administered by the Georgia Municipal Employees Benefit System, which is a board and agency through the Georgia Municipal Association. It includes and covers your regular employees who work 20 hours per week or more for 5 or more months of the year after a vesting period of 10 years. That's what your current plan document says. You get no credit for time served, for unused leave time, or military service. Now, all of those are things that you as a governing body can decide. Some cities, what we call vest their employees immediately. Some vest at a year or 5 years. You have chosen to vest employees at the 10-year anniversary mark. That means that for the first 10 years that an employee works for you, they have no retirement plan. Okay, none. They're here. You're not contributing to something that you all may be, like an IRA or 401k or something like that you all may be familiar with from the private side. There's no retirement plan or contribution for your employees until they are here for a period of 10 years. I will tell you from my experience, that is going by the wayside. 10 years was a very traditional vesting period 20 years ago at the local government level. It's no longer that. The reason for that is because cities and counties are finding it very difficult to compete for talent in the marketplace when somebody can go to the private industry and get an immediately vest into a retirement program and have even matching contributions made to the retirement program, but they gotta come work for the city for 10 years with nothing. So we're losing people, and sometimes I think folks lose sight of, they think about a city being, well, that's a policeman, that's fireman, they don't really have a spot in the private sector. But you also have managers, you have CPAs, you have accountants, you have engineers, you have a lot of water utility folks. All of those people that work for the city actually have private industry counterparts that they could go to work for, and that we are competing for talent with every day. And so your retirement program is an important part of your competitive recruitment and retention package that you're offering. So I think that bears some consideration. Right now, your plan calls for an early retirement with reduced benefits as an option to your employees at age 55 after 10 years of service. Normal retirement with full benefits is at age 65 with 5 years of service. The normal retirement benefit is defined by your plan as 1.5% of monthly average earnings for the 5 years of highest wages consecutive prior to the separation of service. Again, that is the city's formula. As you look through the document, the ordinance that was presented to you, you'll see that you have a number of options. That multiplier is a function of the city's decision-making process. That, just like the vesting, is a function of the city's making process. Normal retirement, early retirement, all of those things can be determined by what package you want to offer to your employees for recruitment and retention purposes. Some retirement packages through this particular plan offer disability. Yours does not. Some cities offer that your health insurance benefits be continued until you reach an age in which you qualify for Medicare coverage. Yours does not. Most of them have an option for cost of living adjustments, that your pension will increase based on the cost of living annually. Yours does not account for that. You have what a very bare bones one. In fact, I think you're the only city whose retirement plan that I have personally looked at that does not cover the governing body. The elected officials are not included in the pension plan, but they could be, and most of them are, at least the ones that I'm familiar with. So what was put before you was a request that was given to us to kind of look at some plan amendments. Now, GMIS is making some mandatory amendments. It's going to cost the city just shy of $14,000 annually. They are simply changing some of their assumptions in their actuarial table. If you have your pension plan through them, these changed assumptions apply to us. So those are just given to us. What is the Plan of 80? The Plan of 80, or the Rule of 80, excuse me, is an amendment that you can make to your retirement pension program that says your years of service with the city plus your age equals, when those two numbers sum or total to 55, you can retire with full retirement benefits, okay? Because if you remember, we just covered your normal retirement age was 65. This will allow for 55. Most of the cities that I'm familiar with are moving to the Rule of 80 for a couple of reasons. The big one is a lot of our team does very physical work. The utilities guys, the parks guys, the streets guys, the public works guys. If you have sanitation, if you have public safety officers, fire and police, they're physically using their body to perform the task that we need of them. And so the wear and tear, quite literally, on their bodies is causing them to have certain issues at younger ages. And so asking them to continue at that level of production up until 65 has been challenging for some cities. And so they have found that the Rule of 80 has been a very attractive retirement amendment for recruitment and retention purposes. You have an actuarial study that was asked of me. As I mentioned, it's being emailed to all of you today. If it hasn't been already, it will be. To adopt the Rule of 80 and amend your plan to pick it up would increase the cost of the city across all funds, general fund and enterprise fund, a total of $63,231 per year, okay? I have been asked if that is fully funded, and I believe that it is. And I have sent that to your auditor. It had to be fully funded through 23, or she would have, noted it as a finding to us. We pay this invoice, I believe, quarterly. If memory serves, I believe it's a quarterly invoice that we pay over to the particular board that manages this, but I have sent her that question for verification. Moving on to your debt schedule. Debt's an important consideration in all of your funds, particularly your general fund. You actually have a statutory debt limit, all cities do, of how much you can borrow and use your general fund as collateral, because that's your tax digest. If you're borrowing against your general fund, then you're basically borrowing against your tax digest. The general fund has very little debt. That was a great finding. That seems to be verified by both the 23 audit and the year-to-date numbers that I have for 25. They're basically for software subscriptions. We have to count that as debt now. Those are very low numbers that you see, and then an equipment debt, excavator and bucket truck. Just so you know, those particular debts and those payments rather are budgeted within the various departments. So if it's a software program that say serves multiple departments, part of that payment will be spread or allocated throughout multiple departments. If it's, say, a bucket truck that was assigned to, say, Public Works or Parks or whatever department it was, that payment will be budgeted as a debt payment in that particular department. Okay. So, again, just kind of hitting the high points. I wanted to show you your general fund department revenues to expenditures for the years that we have them, and get back to a little bit of discussion on your fund balance. At the end of the fiscal year 23, you had an audited unassigned fund balance of $3.8 million. That is really very positive, really very positive. Best practice that the Government Finance Officers Association recommends to the cities and counties is that you maintain in your general fund an unassigned or unrestricted fund balance that's the equivalent of about 3 months or 33% of your operations. You could run a year of your general fund operations off of your unrestricted fund balance. That's excellent. In fact, there's enough opportunity there that the city may want to go and look at restricting some of that for particular uses. So for example, I had a council person ask me, well, didn't we put $500,000 aside for an emergency fund? I did not see any evidence of that, because the way you do, but you could actually pass a resolution that says of this $3.8 million unrestricted unassigned fund balance, we can restrict $500,000 of that for emergency purposes, and you can define what emergency means to you, natural disaster, or tornado, whatever that happens to mean for your city, and you can look that up. So you had a very healthy fund balance at the end of 23. And you'll notice that at 23, you added to your fund balance a little over $900,000. So for general fund operations in fiscal year 23, you brought in $900,000 more than you expended. That's great. Okay, so you were adding to a fund balance that obviously you had been building in previous years at the close of fiscal year 23. As I said, I don't have the data for 24. So I can't give you what an accurate fund balance is for today, because I don't know whether we brought in more revenue than we expended in this particular fund in 24 or not. I will tell you that 25, the current year that we're in, it budgeted at least an $800,000 transfer from that 3.8 to the revenue stream for 25. And so we know we were taking some of that to to fund general operations and capital projects from the general fund for this fiscal year. You'll see that I've run a few projections in year to date, and it looks like we're gonna land somewhere between about $500,000 and $700,000 in transfers to balance this year's budget. That's what I would call a planned deficit, okay? We knew that we were budgeting more in expenditures from the general fund, than we were bringing in revenues for fiscal year 25. Now, the general fund for 25, though, did appear to have some capital projects in it, so that is the significant thing to remember. We have historically planned for capital projects, things like street paving. Think street paving. Street paving would typically come out of a general fund revenue expenditure, okay, for this particular, for your city. We have planned those things out of the general fund. I did not do that in 26, again, to get back to that baseline, to get as accurate a data as I could possibly get. For 26, I have not proposed a transfer of your general fund balance or any of your reserves, again, to get that baseline, but nor did I plan any capital projects for you in 26. Okay, so that would give us just an opportunity, again, to get back to that. What does it take for day-to-day overhead to provide the level of service that we're currently providing? What do our fund balances and our reserves look like? What do our revenues look like without grants? What do our expenditures look like without capital? And then that will allow us to make some other decisions from a more fully informed place, okay? Even if the city moves, and like I said, it planned at least 800,000, it's looking to me like it's gonna be somewhere in that neighborhood, moves the 800,000, to balance this year's books. And even if we moved something like that in 24, which remains to be seen, I would say you're still at a pretty good spot for your unassigned fund balance, for your general fund. And I congratulate you on that, and I will tell you, protect it, okay? Most cities would love to be in the position where they could say they have more unassigned fund balance for their general fund than the best practice. I literally managed a city where when I took over the general fund, we had 6 days. We could have operated the city for 6 days. And that was not, when you have 500 employees and 25,000 residents, and you can operate the city for 6 days, that is not a pleasant experience or position to be in. So the fact that you could come in and, God forbid, the unthinkable happened, and you could keep going for about a year is a very, very positive and very strong place to be in. And so I would urge you to protect it. I would urge you to reserve and restrict some of it. We can talk about how to do that and what those things may be for moving forward. And again, another very positive thing for your general fund is it's very low on debt. You basically had no debt that was really captured in your tax digest as collateral. You could pay off every dime of your general fund debt today. Remember, it was an excavator, a bucket truck, and some software. So what, it totaled like $30,000, $35,000 or something. So your general fund was doing very good from those particular perspectives. Some other conclusions that I just want to share with you on the general fund as we kind of finish that one up. Again, it is self-supporting for operations. That's why, you know, in 23 you added to your reserves. In 26, I have calculated more revenues than expenditures for you. So that's a very good place to be in. Now, the jeopardy, the caveat for that is, again, capital. We're going to continue to talk about that. I think I covered all of this. Let's see. Additional positions, I did want to revisit that. You do have some opportunities because your fund balance is so strong and because we do project revenues over expenditures for fiscal year 26. You do have the opportunity to now consider some additional positions, in 26. You have a vacant position in engineering. When I first became associated with the city, you guys had an engineer on staff. I would say that offers a remarkable number of advantages to you. We can talk more about what that position would continue to offer, but I would recommend that you reconsider adding that position back, and we can talk about what that would do. And I know it's been a common thought amongst this body that you had 3 positions in the finance department. I found no evidence of that in anything that I was able to decipher from fiscal year 25. It looked like 2 positions to me. But in all honesty, the finance department was not, identified independently. You have something called a general administration department, and it was kind of commingling finance with the city clerk's office and some other departments. I would recommend that as we move forward, we try to extrapolate each department and let it stand on its own. So have the city clerk, and that would be in conformance with the Uniform Chart of Accounts. Let the clerk's department have its own budget. Let the finance department have its own budget. Let elections have its own budget. Let tax have its own budget. That's typically how it's done. That's how the Uniform Chart of Accounts is established. And then it would be much easier to go back in and say, okay, that combined with that position control tool that I gave you earlier, exactly how many people did we fund in this particular department? At what wage rate did we fund? And then we wouldn't have this confusion. Also, when the staff's coming to me and saying, like Streets is saying to me, we're understaffed. We have historically had more people. We need more people. Immediately I can look at, whether operationally I agree with that or not is a different question. But one of the questions is, did we fund those people? Do we have the financial means to actually add to our staff? I couldn't necessarily tell that a lot of the times. And so my answer is always gonna be no. If I don't have the money, if I don't know I can go buy something, I'm not going to go buy it, right? So having those broken out would give you a lot of benefit. But because revenues to expenditures for the proposed 26 general fund are higher, the revenues are higher than the expenditures, and you do have a strong reserve account to lean back on, if you wanted to incorporate these additional positions moving forward, you have the opportunity to consider that. You have some wherewithal to consider that. So, excuse me, that's a great opportunity. A couple of concerns that I have for the general fund. The primary one is coding, because we were without a team staffed in the finance department for so long. I am very concerned that things have not been coded in accordance with the Uniform Chart of Account. If they're not coded in accordance with the Uniform Chart of Account, then I can't give you accurate information, right? So I'm a little concerned about that. Moving forward, and again, putting that purchasing module in place and making sure that our team is trained on that, and making sure that from the very beginning, from the point a request is made to purchase something, that those account numbers are put into that request, department leaders are verifying those account numbers, and then the finance team are verifying those account numbers, and they're doing so at the purchasing stage, will help make sure that we are coding everything properly and correctly, and it also will cut down on the lag time at the end of making sure things are booked, because it's gonna book automatically and it's gonna book correctly. Here's my other concern for the general fund, and this one is really important and bears some discussion, and will move us right into our special revenues. The general fund revenues, although they are more than the day-to-day operating expenditures, they are simply not strong enough to carry a capital improvement program, okay? Capital improvements, again, are those kind of bigger ticket items that are gonna last us more, a couple of years or more in operations. So think about your information technology infrastructure, your fleets, your equipment, your cars, your trucks. But in the general fund, it's also things like buildings and building improvements and maintenance and repairs. It's building, if it needs a new roof, where's that gonna come from? It's gonna come from your general fund capital program. Paving streets. We've had a lot of conversation in my time with you about certain streets that needed to be paved. That would come from that general fund capital program, okay? What's another big one for you guys? Stormwater. You talked to me a lot about your concerns for local flooding and street flooding during major rain events, and having stormwater infrastructure in place that prevents that and addresses that. Blue Ridge does not have a stormwater fund or a stormwater utility, so you are pulling those infrastructure dollars from your general fund. Well, remember I said your general fund is the one that is most primarily dependent on your taxpayer. So you really wanna move any expenditures off that taxpayer's burden that you can. Right now, we're putting all of those capital pressures on that general fund. That's why in years where you have spent more than you have earned in that general fund and pulled from your reserves, like we're gonna do in fiscal year 25, it's not been daily operations from what my analysis at this point can determine. It's been your capital, okay? Now that begs the question, well, we have SPOS accounts. I'm gonna skip ahead to SPOS. Why aren't our SPOS accounts picking up those capital projects, because that's exactly what SPLOST is intended to do. SPLOST is that special purpose local option sales tax that's dedicated and lawfully restricted only for capital projects that you share with the county. Well, you have two series of SPLOST. The first one was in 2017. I want you to look at this chart. You were committed, and that one's off center, I'm sorry. You were pledged, or expected is a better word, let me correct that. The city expected to receive $2.1 million in the proceeds for that series of SPLOST. You spent $2.4 million. Okay, so, and the collections on that particular series obviously have ceased. So if you're spending more in SPLOST than you're collecting, there's an issue that we need to address. So obviously SPLOST 17 couldn't couldn't carry the capital burden for the general fund because it was overburdened itself, right? In your next series of SPLOST, this is the information that we have year to date. Your total collections over a 6-year period for the city are capped at an expectation of $4.2 million. That's a drop in the bucket of the SPLOST proceeds that are collected in this community. And it is a drop in the bucket of the cost that it takes to carry a capital program. About 15 years ago, it cost about $100,000 to pave a parking space. Miles of road paving. I think this year the council wanted, if memory serves, $1 million worth of paving done this year. Y'all remember that? I think that number is correct. So if you only getting $4.2 million and it's coming in quarterly, monthly, over a 6-year interval, that's not going to service your capital program. So where you run deficiencies, it's been here. Okay, this is your struggle, is funding your capital program. So you don't have a dedicated source for paving that's gonna really pick up the kind of paving dollars that you guys are looking for. You don't have a dedicated capital source for stormwater improvements or stormwater infrastructure that you guys have asked for. You see here your recreation number is very low. It's less than $200,000. So this is where I'm concerned about your general fund. This is where I'm concerned about your special revenue funds and your SPLOST accounts, is because we're really not adequately equipping a capital expenditure program. Okay? Now, I just talked a lot about general fund and the two special revenue sources that support the general fund. This is a great time for me to take any general fund or SPLOST or any questions before I move into the other special revenues or the water fund. Is there anything that I can tackle for council at this point on these particulars? Okay. Y'all hanging with me? All right.
And if new council members have any questions, you're more than welcome to ask.
Okay. One of your other primary special revenue funds, and we're all very much aware of this, we've talked about it, is your hotel motel tax fund. As Tacey went over with you at the last session where we discussed this, there are what we call restricted and unrestricted portions of your hotel motel tax fund. You would probably remember that one of her findings in 2023's audit was that we had not properly allocated some of those and had not properly expended some of those. We have tried to correct that for fiscal year 24. We found some opportunities to do that. I'm not confident that we fully rectified that in 24, but we have attempted to do so. And for 26, Tacey worked with me. I gave her a plan, and she confirmed that it should meet audit expectations for how you divide those revenues for 26. The great news about the hotel motel tax fund is this. Number one, you have a fund balance. You have a reserve account in your hotel motel fund. At end of year fiscal year 23, it was just over $1 million. I don't have information that would say that the 24 numbers will do anything but build that particular reserve up in a positive way. Some of that reserve is unassigned, unrestricted, and you guys can actually move that for capital projects or general fund operations or other support that you would like to give to some other needs and opportunities with the city. Some of that is going to be restricted for those particular projects that you have to do, but as you, to be lawful with the use of those funds. But some of the projects that I've heard this council talk about desiring to complete, like downtown restrooms and things, Tacey talked to you, those actually would comply with the lawful restrictions on the use of those funds. So there's some opportunity with that hotel motel tax to use those reserves that are hopefully gonna continue to build. Because again, for '24, I anticipate that they will continue to rise, just based on what I know today. Based on what I know today, I also expect the '25 hotel motel tax collections to do well and to continue to build those reserves that you could put to work. For '26, and the proposal for you, because we do have to have a budget, a fund, this is a separate fund than any other, and by law it has to stay that way. I did work with your auditor to make sure that we were accounting for those restrictions in the law correctly. I held your projections at your revenue collection very steady. I see no reason, I actually anticipate that they will continue to increase, but again, just being very conservative, I kept your revenue projections very steady. I kept your required contribution to your destination marketing organization, which in your case is the chamber, at that required percentage, and again, very steady, which is right now around $370,000 annually. And then, like I said earlier, I moved some expenditures off of your general fund to this fund. It's compliant, and it just continues to relieve that burden from your taxpayers. And two real important things that I did for you, and again, this is your discretion, but two that I'm suggesting to you is, number one, I budgeted for you in this fiscal year '26 proposal $100,000 for downtown parking improvements. And by that I mean parking fees and enforcement. We had a lot of conversation anecdotally about, well, should we charge for parking? Some places we do, some we don't. Do we charge the right amount? How do we enforce it? There's technologies and tools that cities every day use for parking monitoring and enforcement. I put $100,000 of the hotel motel tax restricted funds for that use in this proposal. The auditor has assured me that she thinks that qualifies. So this is an opportunity. You've got revenues that you can use this for, and that can address an issue that you guys are grappling with. And some back of the envelope numbers would demonstrate that that investment would return itself to you greatly in the form of revenue, and that can go to your general fund, okay? If you have parking revenue, that can go to your general fund, which again is gonna decrease your burden on your taxpayers, okay? So I've done that for you. The other thing that I have done is I have transferred some of your unrestricted revenues in the fiscal year '26 to your general fund, just as a transfer, or what we would think of as a subsidy, okay? So I've transferred for over $400,000 as a subsidy, which is lawful and smart to do, and everybody does it, okay? So that you're supposed to, remember we said we had restricted portions of the hotel motel tax and unrestricted portions of the hotel motel tax. The statute contemplates that that unrestricted portion will go to your general operations or support other needs and challenges of the city. Well, by moving $400,000 in '26 to your general fund, we just moved half as much as you're gonna collect in property taxes for the year from your hotel motel excise tax, okay? So that is in the proposal for '26 hotel motel tax. All right. Confiscated assets is a fiduciary fund that we have to keep up. It's in your budget because it has to be. Those are literally the assets that the police department and their partners seize and collect and are turned over to us by court order. I never see any revenues or expenditures go into this, because how would you predict them? You know, and I think we've got $5,000 in it, so nothing to be writing home about there. ARPA is a special revenue fund. This is a grant from the federal government. This is the holdover from from COVID dollars. These collections have ceased, and these funds have been committed to some water projects. So it's accounted for in your budget because it has to be. But again, that would just, they're there, and we have to use them for water sewer. There's a defined project for it. So I wanted to bring it to your attention, but it's not really for us to concern ourselves with how to program, because it's already been programmed. Any questions on hotel motel or special revenues or capital?
On the hotel motel, I know previously on council, we had taken the unrestricted portion and done like, put a new playground in and stuff. So could council, if they chose to, on the unrestricted, set up a certain like a account for projects they may want to do, such as.
Absolutely. In fact, you can restrict your use of hotel. The unrestricted portion is in council's discretion to expend in any lawful manner that you desire to do so. And if you even would like to build restrictions into that as a financial policy for yourself, you can do so.
Which is the money you've already moved into the general, so, or for the 400,000.
For the FY 26 anticipated revenues, yes, I moved it to the general fund.
Yep.
But you are gonna have some fund balance to work with there.
Okay, good.
See, to me, because I know even last year working on the budget, I personally would like to see that money from hotel motel, the unrestricted, in a fund by itself. And so in a 3-year period, you can kind of see, if you don't spend any, you can say, hey, we got $1 million. We can work on this project that we wanted to, or we can whatever.
So let's talk about how you would do that. So the hotel motel tax is an independent fund, FUND. It has to be accounted for independently of all other revenues. And so that happens. And so in your audit every year, I know you have at least $1 million in fund balance, because when your auditor looks at your statements, they run a fund balance calculation for the hotel motel tax fund every year. So that's where that $1 million number came from fiscal year 23, straight out of your audit. As a financial policy, the council can actually adopt, if it would like to restrict any of that, just like you can for your general fund. Remember, we talked about for your general fund, you can restrict your reserves or your fund balance in certain ways, and that's a vote of the council, or it's the adoption of a financial policy. Whether you say specifically, I want to restrict this much of the fund balance for this particular use or need, or whether you adopt a policy that says we will always keep 10% or 25% of the available fund balance in the hotel motel tax fund for playgrounds. That's up to you. You can handle it either way, but that's within the discretion of the governing body.
Well, I say that one thing is because we still do, Christy, we still do have a playground to put at where the pool is.
Yeah.
The city will help. I mean, the county is going to help on that, but we've got to come up with money, and I just think the hotel motel would probably be the appropriate place to get it, hard to start.
I think that's a great discussion for you guys to have. I think you're going to need to have a more in-depth discussion in 2026 about your capital projects and playgrounds and parking and those sorts of issues, restrooms downtown, improvements to the farmers market, improvements to the depot. All of those things are considered capital projects. And so my recommendation would be that you guys have a discussion about what capital projects would you like to implement a plan for. And typically you plan for capital projects for a period of 5 years. And once you identify the projects, you allocate the particular revenues to it. So then you could say, okay, we want to use hotel motel tax for this. We want to use, assuming you have any SPLOST available, you want to use SPLOST for this. So you see, this one I think we should use general fund for. It's that important. But that really needs to be done in a very responsible way, where you tackle what capital projects, including playgrounds, amenities that you want to offer to your community over at least a 5-year period, and then identify and balance the revenues that are going to be used. Because I know I've heard a lot of discussion here about SPLOST, and we just saw, sometimes we were spending the same SPLOST dollar twice. And so that's a real concern. So having those capital discussions, including those types of amenities, and including hotel motel revenues in it would be a recommendation for this body moving forward.
And the TPD could actually be spent on the playground rather than all going out of restricted. But if there wasn't enough,
I'm not confident that the TPD could be used for playground. I would seek the auditor's opinion on that, because there's some pretty strict rules on those uses. So I would just ask for her opinion before I made that commitment.
Well, I think the county did, and I'll talk to the chamber president, but I think that because they added some playgrounds at Horseshoe Bend and just some different places in the county.
But it's your auditor that's going to make the finding whether you are compliant or not.
Yeah, I would check with the auditor. Mandy, I did want to point out also, Jack Taylor did make a motion in 2024 to allocate $500,000 to go towards emergency funding. I heard you mention that, but that motion was made, I believe it passed unanimously. You guys recall that? So it did.
Was it per year though, or was it, how was it?
No, it was just a one-time.
Okay.
I believe it was one time, but anyway, that is out there, if, just FYI,
Okay.
so.
We'll make a note of that. Okay. All right. So an enterprise fund, the city of Blue Ridge has one enterprise fund, it's your water sewer fund. Now, an enterprise fund is just what it sounds like, it is an enterprise, as in a business. Okay, there are no tax revenues that support the business of the water sewer department. It is a department that is funded by its charges for services. It is supposed to be self-sustaining. It is supposed to, ideally, in a best practice world, your enterprise funds, including water sewer funds, collect enough in charges for services to cover day-to-day operations, to cover rehab and repair of the assets in the system, expansions and extensions of the system, depreciation of the system, as well as, in an ideal world, and in a lot of cities, generate what would be commonly considered a profit. Okay, and the reason for that is, again, you do not want to draw off of your tax dollars to support the business of selling water and sewer. And more importantly, if you generate enough what would commonly be thought of as profit in the water sewer department, you can actually transfer that to other funds like your general fund and subsidize those operations, again, relieving the burden on your taxpayer or capitalizing your capital fund, okay? You know what I mean? So you have some opportunities to run your water sewer business in a profit-making way if you want to do so. This is just a historical report on your operating revenues for fiscal year 26 in line with your previous historical data. We're anticipating somewhere around $4.8 million in operating revenues. And then you'll see something called surcharge revenues down at the bottom, and these are included in your revenue projections for the budget adoption. Surcharges here are what some communities would call an aid to construction fee. Kind of layman's terms would be impact fees, okay? A way to look at that is sort of growth pays for itself, okay? So if you need capacity in the treatment plant, water or sewer, if you if you need some reservation of a future service, that could come in the form of a surcharge. Now, I say commonly called an impact fee. That's a technical term. I just want to caution you, Georgia has an impact fee statute, and there's a lot of hoops you have to jump through to technically have an impact fee, okay? But so if you commonly hear that term, your surcharge account is probably what they're referring to, but it's not legally technically an impact fee. But you can see those numbers are really pretty low, you know, $200,000 a year. So again, that's not gonna cover any capital, okay? So we're gonna, again, have to address capital in this enterprise fund as well. Your water department, your water fund, has a number of operational divisions, and I have listed those for you there. And what I also gave you are your expenditures for those particular operations in each of those divisions. So when you tally those for your trial balance in operations, you spent about $4.3 million in the water fund for fiscal year 23. You'll see for fiscal year 25, that's projected to, our year to date is closer to 5.5 million, and for 26 is in line at about 4 million. Now, you'll see that what's not included in that again is capital projects, okay? Again, just getting back down to that. What are we bringing in on charges for services, and what are we spending out just to keep the treatment plants going, both the water plant and the sewer plant, you know, to keep our lines maintained and keep the water flowing? What does it take to do that? Here's something I really wanted to show you. Looking at the 25 year-to-date projected and then proposed, and what we know of 23, and I apologize, I left 23 out of that chart. I'll add that for you and send it to you. Tacey spent a lot of time talking to you during your audit presentation for fiscal year 23 that the water fund for fiscal year 23 netted or made $70,000. And I would tell you that's a bit high in my estimation, because about 40 or 45,000 of that actually came from interest that you earned at the bank that year. So really, and you can't count on interest, I mean, the Federal Reserve just dropped interest rates this past week, right, this week, so what we'll earn will continue to go down. So you really made about $30,000 more than you spent in fiscal year '23. And so, that's concerning. What continues to be even more concerning is that, in fiscal year '25, I anticipate that you're gonna spend a lot more, over $1 million more than you earn in revenues for the water fund. So this is the fund that, in my recommendation to you, deserves the most attention and the most immediate attention. In your '23 audit, you'll find a listing of all your debt. That's one of the things that the auditor has to do every year, is independently verify all of the debt that is taken on all of your funds. This is the debt that is identified in your '23 audit on your water fund. And you'll notice that the payoff for that is just at $18 million. When you're making $4 million a year and your debt payoff at the end of '23 was $18 million. I want to show you something. No, I didn't do it. Yeah. In '24, my best information to date indicates that the water fund took another 2.5 million or so in debt disbursements. These are disbursements that will turn into debt, and that was in '24. I've not yet been able to get enough of a calculation on the '25 loans to have an accurate number for you for your '25 debt incurred. Why does that? Well, obviously that concerns me, because are our revenues strong enough to support our debt load? And I would tell you that they're not. And one of the reasons I would tell you that is because I had the auditor run a debt to income ratio based on the audited fiscal year '23 numbers. And that ratio is a 1.39. Your required ratio for GFA note compliance is 1.05. So at the end of fiscal year '23, you had more debt than you were allowed to have based on your charges for services that were being collected. That was at '23. We know we have taken more debt disbursements, loan proceeds in '24, and we know that we have taken more in '25. Also look at what's called your net position in your enterprise fund. That's what in your general fund would be termed a fund balance, or what some of us would think about as our reserves or our savings account. It was good. It was okay. It was $3.5 million, but that was in '23, and I don't know what has happened in '24, and I don't really yet know what has happened in '25. So I would, as long as that net position stays at that 3.5, you would be in good shape. I just don't have enough information to comment on that at this point. So, although the fiscal year '26 numbers that I've given you for proposal and consideration for this enterprise fund budget for '26, revenues exceed expenditures, there are no capital projects planned in this '26 proposal, none. And that includes all the capital projects that you guys have previously approved and the debt that you have previously approved to take on with those. And again, that reason is to get you a baseline. What are your operations costs? Are we covering just our operations cost? Barely, sometimes, in the water fund. You're certainly not covering your capital cost. So several things really need to happen here. One of them is already happening, and that is a reevaluation of your capital projects that you have previously approved. Just this week, your team looked at one project, the one that the staff identified to us as being urgent and on fire and most necessary to be dealt with, which is a booster pump station repair. We had an engineering design with an anticipated construction cost of $600,000. We got a GFA note for $600,000. What's the tab? 25?
I'm sorry, on the,
Pump station?
well, the last quote we got was 75,000, but we're gonna reevaluate that, now we got another
And so what's happening there, that's a perfect example of where, you know, we committed to borrowing $600,000 to make a repair that we're thinking we're gonna actually get made in the $25,000 to $75,000 range. So what has happened with that one project is currently happening with every project that the water fund has committed to that has not been started or completed. We have stopped construction where we can to stop spending money on any of these projects. We've done so without hurting service. No one has lost service because of this. No one is out of water. Okay, we've been very mindful of that, of course. But we've gone back to the engineer. We've gone back to the design board. We've gone back to the construction guys. We've gone back to the staff, and we're looking project by project what actually is required, necessary, urgent, mandated, what can be done, where can you get Band-Aids that may last for a dependable length of time. And we're trying to whittle down this debt load for you guys, okay? And the more we whittle down this debt load, you know, the more then we'll begin to be able to reincorporate some of these projects into your budget in 2026. But today, in this proposal, there are no capital projects contemplated in your fiscal year 26 enterprise fund, okay? So that we can continue to move forward, evaluating even those projects that were, quote, approved and funded through a note, but where we had either not started the project or we were at a point where we could stop the project so that we can reevaluate the necessity, the timing, the engineering, the design, the construction cost, and the necessity of those projects. And just that one is a prime example. That was the project that, as I said, everybody said, oh, this is the one that's most on fire, this is the one that was most necessary, and we borrowed $600,000 for it, and we're hoping to spend somewhere in the neighborhood of $75,000 or less. So that needs, you know, to continue to move forward in these final weeks and into next year, and be revisited and then incorporated into your enterprise fund budget.
I didn't mean to interrupt.
Go ahead.
The only thing is the Highway 5 project.
Yes.
How do you make up with that?
Go ahead. You're
No,
fine.
it was just that's what we gotta look forward for 2026 coming up. So
Mhm.
the numbers from the other.
Yes, thank you. And that originally was estimated to be $1 million project. The last estimate I saw was somewhere around 100,000.
You know,
So,
there's two phases to it.
Mm.
and I am speaking about just the most immediate phase when I give you those numbers. Again, you really, my recommendation would be that you continue to look not only at your capital plan, and your debt and your needs there, but also your rates. There has previously been, go ahead, Mayor, I'm sorry.
That's what I was going to ask. Does this proposal reflect the 5% that I've requested as what, you know, with the bulk rate and as well? Because I know we're losing money, according to all sources, selling in bulk, like to the county, except, you know, places like that.
That's
And
a-
with the 5%, which has been recommended to do 5% for 5 years, and this will be the third year.
It does not, and you did make that request, and
Mhm.
I just contemplated your current rate structure.
Mhm.
But that's certainly something that you guys could approve when you adopt this budget, is that there be an across-the-board rate increase of 5%, and that, you know, that could go into effect. Typically what, to your point, what cities and counties and water authorities do is they make their capital plan, so they know, you know, they have an idea. Now, you're always gonna have things that come up, right, in a utility. But you identify the projects, the capital projects that you intend to work on and complete in the next 5 years. You draw your cost estimates up, and then again, you identify revenue. So if you have a little SPLOST, which you have a little that you have legally encumbered for water sewer projects, because that's what the voters approved. And on a SPLOST referendum, you go where the voters approve you to go. You have a little fund there. You have some ARPA funds that have been committed for a particular project, so we would dedicate those. And then your surcharges, you know, where would we dedicate those? And then your rates have to pick up what's left. Now once you do your capital projects, then you can really move into your rate studies. Now your rate studies, in my view, really should concentrate on a couple of things. What is the rate to recover your cost of selling your product? Okay, and you have different rates based on classes of customers. Is it a wholesale customer or what we call a retail customer? Is it an inside customer or outside customer? Meaning, is it inside the city limits or outside the city limits? You can do that because there's different costs associated with serving those different classes of customers. It costs a different rate to serve a residential customer than it does a commercial customer. So all of those things can be identified in your rate study once you've built off a budget. You gotta have audited numbers, budgeted numbers, and a capital program to accurately calculate a rate study, okay? Because that rate study is gonna look at, well, what did it actually cost them in the last audit to run the utility? Your budget's gonna show them what are you anticipating to spend, so what are your needs, your planned spending, they're gonna consider that. And then they're gonna consider your capital projects that you're committing to, and they're gonna put all of that into the methodology of conducting the rate study, and flesh that out. And then what it will do is show you, what your increases need to be annually or whatever period you want to have to keep your rates at a level that will recover your cost of operating the utility. You can also then go in and build in things like depreciation. Assets wear out. We all know that. We all have to buy a new car every so often. It's gonna stop going, right? So you have to repair water lines. You have to replace water lines. Treatment plants, you just did a huge upgrade to your sewer, a very expensive upgrade to your sewer plant. So if you are funding depreciation, then you fund it in your rate study, then you're building a pot of money, into your revenue stream that the next time you need to upgrade or rehab or rebuild, you don't have to go borrow it. You've got some funding there set aside to do that. You can also build into your rate study that where certain parts of your system place a heavier financial burden on the system itself, you can place assessments on those particular customers so that they are paying for the enhanced cost for them to receive that service or that upgrade or whatever that necessity is, rather than those huge dollars being spread across the entire system and other customers are subsidizing the cost that are really only going to benefit a few customers over here. And you can build, if you have a capital plan, then you can build all of that into the methodology and go into your cost study. And you guys have some historical cost studies and some rate reviews. You do, that's great. I would just tell you they need to be updated, and they need to be updated to reflect a capital plan that you guys are committed to with some current cost numbers. And it needs to be updated with instruction on whether you want to consider those assessments to those particular customers that benefit from those investments from the utility as well.
So at this point, if we go by the rate study that's been conducted, we could go ahead and put the 5% increase in, and that would at least cover so the rate study was done by Tony King to kind of cover the projects that we had going through this year. And of course, we have incurred, the new stormwater. We have a lot of things going on with just the general. But for the water sewer, it has indicated a 5% for 5 years. We did 2% 1 year. Last year we did 8% to compensate for only doing 2% the year before. And then this year would be a 5%. Next year you do 5%, and then the next year. And that would, so with that rate study, but as she said, there are new things that have popped up, new issues. So you would probably need to incorporate that and then do your special assessments for certain areas that are causing more. And I think Ms. Cody can certainly help you with that in the future and get that on track. But personally, I would like to see the increase, because why would we not, when that's the one area that's questionable, the one account?
Is that a 5%, like, for everything, the
Water,
wholesale
sewer.
water, that's everything? That's to the city customers, water, sewer bills?
So if you all wanted, that would be a separate resolution that would require a separate vote of the council where that would be specified.
But you could incorporate it into the budget at least.
Yes,
Yeah.
we could incorporate it into the budget.
And then you guys could vote on it in January, so,
Yes, absolutely.
yeah.
But
Because if you're not, you're really not doing what the studies has, if you're falling behind, in my opinion, so.
To me, water and sewer is high already. I mean, it seems high to me, so I don't know compared to other cities, but, I'm just.
It's high, but you have expenses, as she's just stated. You really have to.
I mean, you can, so, high, again, that's a relative term. Now, I will tell you, there are dashboards out there. There's some great ones, the University of North Carolina Environmental Finance Center has a great dashboard. I haven't been on it in a couple years, but I assume it's still out there, where you can kind of go in and you can look at what other systems charge. And you can compare it by, say, the number of meters or population or, you know, different geographical areas. GMA may have one now. I'm not sure. They have put in some new dashboards recently, and I haven't looked at all of them. But that is a comparison. I would just caution you, like what the mayor's indicating, don't get caught in, you know, well, town Apple over here, you know, charges only this, and we have to charge, you know, 3 times this. It really, your rates really need to be based in the methodology of your operations cost, you know, your capital cost. And it's a business. I would remind you that, you know, it's designed to be a business. And your assets are going to deplete. They have to be replaced. We all have to buy new cars. We all have to keep our homes up. I mean, it's the same principle here. You have to invest in the asset. And this is a necessity. It's an essential service. It's water. I mean, we all know that. So I know sometimes it's difficult to raise rates, but really ground those rates in what your system needs and requires, and think carefully about what your system needs and requires. And do the due diligence like we're doing right now. You know, look at the necessity and the mandate on these projects. Look at, can you think differently about the approach to these projects to save funds? And you can get, I think then you can get to a tolerable rate. And particularly because you do have some choices and some opportunities with classes of customers. You know, I mean, it should be a cost recovery rate. The more your customer demands and draws on that system, the more it costs to service that customer, the more that customer should pay. That's the best practice for an enterprise fund. So, you know, Mrs. Smith over here, who has 2 bedrooms and a shower and a washing machine, you know, she shouldn't be paying the same amount, and she lives, you know, 2 doors down from the treatment, from the plant. She should not necessarily be paying the same thing as a big commercial structure outside the city limits, you know, that has lots of demand on the system for various reasons, and then requires a pump station on top of that, you know. So you want to, it takes a lot of energy and effort and resources to think deeply about your system's cost and the cost recovery, but I think most people find it to be very worthwhile, and their customers appreciate it.
Yeah, I mean, 'cause we can't lose money.
No, and then
To supply,
if your customers know, well, if I'm Miss Smith and, you know, my bill is this, it may feel high to me, but they can justify, you know, the city can justify the reason why my bill is that, and my bill's not the same as, you know, a big commercial development or a hotel or a short-term rental or whatever the case may be. And customers, in my experience, are very receptive to that, because you can demonstrate the why, and you can demonstrate that they're not subsidizing the bigger demands down the street.
So I know I've had several questions from council and upcoming new council members about the proposed pension increase, and just wanted to see if anyone had any questions on that at this point, because that would be something, if we move forward, we would have a first reading tonight. So
that was funded in your proposal, so just so you know, the pension plan increase, the merit increases, and the other increases to cost of personnel, like the health insurance went up 8% this year. You know, all of that is contemplated in the expenditure side of the proposed fiscal year 26 budget.
So does anyone have a question about that? You did a good explanation of it, by the way.
Thank you. Yes, sir.
So you said it's gonna go up $63,000 annually, but in the budget, just doing rough math, the retirement line item for every one of the details goes up $159,000 total. What's that difference in?
Well, it's twofold. One is primarily me trying to make calculations based off of the limited data I had based on personnel. So remember, I've talked a couple of times now about trying to really identify which positions were funded in which departments, and even down to which position was in which division and at what rate of pay. That's been a little difficult for me to nail down with the data that I've had available to date. And additionally, a lot of positions are allocated. The cost of those positions are allocated across multiple funds and even multiple divisions within a particular department. So if you had a full-time city administrator, for example, their salary should be allocated across all of the funds that you have, because they service all of those funds, right? So it should be 100% of the general fund. as opposed to if you have, I don't know, a fire chief, which you don't, but I'm just, he or she would be 100% funded in the general fund and the fire department. That's easy, that's where they're gonna serve.
I'm just comparing the total of all the funds, so if you've got that problem in the fiscal 25 estimate to propose 26, you still have that same problem in 26.
I do.
And a rough calculated $159,000 increase, which is different from the 63,000. And if you had that issue that you don't know, how did the actuarial study that was done in October, I think,
Because they're not trying to allocate across the different,
but they came up with the 63,000.
they did, and I would like to see where you're coming with your math, cause and I don't wanna do that right here at the table, if I may finish my thought, if I may finish.
Since you asked me, I'm just taking the general administration line item that says retirement, and it goes from 5,000 to 33,000, I took 33,000 less 5,000 to 28,000, and I did that all down the thing, and came up with 159,000, not 63,000.
Well, 63 is the increase, it's not the total amount of the retirement program. It's the increase in the,
If the projection for 25 is this number, and the proposed 26 is this number, the difference is an increase.
I'm sorry, I didn't follow that.
So the projected 25 numbers add up to whatever they do, that is the number that's gonna be spent in 25. And then the 26 proposed, I come up with $159,000 difference. That's just the two numbers roughly done here. It's not 62,000, it's 159,000.
Okay, I'm gonna try, this is the best I know how to explain this from what I'm trying to deal with. We have an actuarial study that, from October, you have a copy of it now, where they did a census review on our payroll, our total payroll. They were not trying to allocate that across different funds or different divisions or share salaries in any kind of way. And they gave us a cost for the retirement pension plan that was $200 and some odd thousand, which was gonna be an annual increase of $60 some odd thousand to adopt the rule of 80. I have admitted to you several times, and I'm doing so again in public, that I don't have dependable data, nor do I have enough personnel data to know how those allocations have been previously made. So I have overestimated some things to try to make sure that you are adequately funded. Those need to continue to be revisited. I can't, the three reports that I have for where personnel was funded are contradictory to one another. And only one of the reports attempts to even show me the allocations for different personnel across different departments, and then it doesn't doesn't break that allocation down into divisions. The water department itself had 4 or 5 or 6 different divisions. So I don't doubt that those numbers are more than the annual cost of the retirement. That's just the best that I can do with the data that I have available to me today.
So how did, if you don't have accurate data, the actuarial study, actual payroll data over the first 3 quarters of 2025?
They just pulled a total payroll number from us and a census of our employees. And they did their math, and you have what I have. So the pension program is, I had it on the slide, what is it, $223,000 a year, I believe, if memory serves. And that is citywide. And we've got to be able to figure out how to do the work to get it properly allocated. But it's, so if I've overestimated in particular departments, I'll own that. But you have the cost study in your packet. The pension plan is, I think, I'm gonna round up, $225,000 annually for citywide. And that would include, if memory serves, the amendment with the rule of 80.
To me, it just seems like it makes sense to not do something like this that's gonna be a cost, additional cost, without really knowing what it is until the audit's done and some other things we have more of an idea, or they'll have more of an idea where the finances are actually at. I mean, they could, then after January, February, whenever the audit's actually done for 24, and you've got all your numbers in and everything's done, to me, it would make more logical sense to do.
Typically, I would agree with you. I mean, that's a very sound point. I can't really argue that point. I've stressed to you guys the accuracy or lack thereof and and the currency or lack thereof that we have in the data. I would tell you that I'm balancing that against, the needs you have to recruit and retain staff at the city. That's a challenge. And it's going to be, it's going to continue to be a challenge. It's a challenge for all municipalities right now. So just how do you balance those things? And, we did not contemplate a COLA. And so I would say it's a sound argument to amend the retirement plan, when you did not adopt a COLA. And
Well,
I'll
to
think
me-
about that.
To me, I personally think if I was incoming, I would want to just look at the pay scale even and see if people's really where they need to be. I mean, some of these I've got.
They are not. I can just,
Right,
yeah.
right.
So your hourly rate and your annual salaries, are very low.
And so to me, that would be something that needed to be addressed before something like this, and that could be a big cost too. I mean, so I just think it might be getting the cart before the horse
You're
a little bit.
And it may be, I mean, that's a fair point to make. I will tell you that because time does not allow for us to even look at where personnel are being properly allocated, like I just addressed. It has certainly not allowed us to look at a compensation plan. So the last compensation plan that I was able to find that council had adopted was back in 24, I think. I have it here in my book. There, to do a proper compensation study just takes more time and resources than we have. So I've sort of compensated for that in this proposal by picking up this rule of 80 and funding the retirement, and also picking up the increased cost of the health insurance to the employee. You add that and the merit increase, then that's a way to say to your team, both current and future that you're trying to recruit, hey, we know that our market rate by hour or annual salary may be a little low than these other folks that you're talking to about going to work with, but our retirement plan's better, our health insurance is better, and it's gonna cost, so it gives you a tool to work with in the interim until you can get your salaries looked at and adjusted properly.
So you didn't add the COLA to help compensate for this? That's my
I did
Okay.
not, that's right,
Okay.
I did not add the COLA, so there's no COLA. We did pick up the increase in the health
Mhm.
insurance, and we did pick up the rule of 80 in these
Mhm.
calculations to the best of my ability with what I have, and we picked up a merit.
But each year it seems like insurance goes up. I mean, last year it was like close to 10%. It's
Mhm.
eight, I mean, at some point though, I don't know if it's, I mean, this cost and then plus another 10% every year on insurance and just different things. I mean, how sustainable is that on the long term? I mean,
Yeah, that's a very fair question. So your cost share, in all fairness, the cost share that the city picks up on health insurance is very generous. What the employee portion of health insurance versus, what the city's contribution to paying the health insurance is very generous. Much more generous than a lot of places do. And I would say, again, that's right now you're having to use that as a tool, and is it sustainable? I don't know. That's something that you're gonna have to look at, moving forward. But again, and on your retirement, I will say to you, I'm not aware of anybody that has a 10-year vesting period any longer. 10 years with no retirement plan, it's hard to recruit folks, particularly professional people, because again, a city doesn't just run on, physical labor. It does. Those guys are essential to us. But you're also competing for IT folks and CPAs and professional engineers and, professional managers and folks who come to you who have very marketable skills in the private sector, and you wanna tell them that for 10 years, there's no retirement plan here? That's a hard sell.
So
That's a
that-
very hard
yes.
sell.
That happened with us last year with one of the finalists for the accounting position, and they would not take the job because of that.
I mean,
Yeah.
I will tell, I've worked in cities that had no vesting program, and I've worked in cities where I actually had, what's akin to an IRA, and they matched my they put in a certain percentage, and then they matched my percentage, so it was very competitive with the private sector, so that's what you're competing against, and, ask your chief about trying to hire a police officer right now. You cannot hire certain professions that we depend on, so where you can be competitive right now in the health insurance, in the retirement, in some of those areas, your point is valid. The Councilman-elect's point is valid. I'm not arguing that. I'm just telling you, you've got to balance these things right now.
Go ahead.
I think now that I've seen this
do.
Yeah. This should be looked at in a very comprehensive way. I'm not opposed to forward to the B plan for city employees, where they make a contribution, the city matches that contribution. So a new employee would go into that type of system and forego that retirement if they chose, or have a combination of both is available. This needs to be redone
Agree.
very extensively and done right for the future. And in light of, you're not even budgeting capital projects going forward. I think if I were an employee today, and you gave me an option of something in the future, retirement or a COLA increase this year, I might choose the COLA increase instead.
Yeah.
Because that's money in my pocket today. If you ask most people, they may choose that. That may not be a great choice for when they get to be 65 and retire. But looking at the options that we have in here, this is pretty comprehensive. And I think we can go into the year, let's get our numbers right for 24, let's get our numbers right for 25, and then go into 26 and say, okay, the 27 budget, yes, we can adopt this, we can do this. We may find that we've got other things, but when they're telling us we have no capital money at all for 26 allocated, this may not be the right time to change this.
Plus, I
I
look
agree.
at like somebody that's making a low wage is not gonna stay around 30 years to get a good retirement, you know, I mean, so to me, the wages for, especially for the younger generation, a higher wage is more important than a good retirement, in my opinion. I mean, just like he was kinda saying, I mean, not for everybody, but, you know, but your professionals maybe not, but, you know, you know, so there's different ways to look at it, but I'm like, you know, I think there should be, I just think it makes sense to review it, because it's been a while, I believe.
It's been a number of years since,
Yeah.
I looked at the last
Yeah.
date on the plan amendment, and I don't have it in front of me, but it's been quite some years, yeah.
Yeah.
And this is something, if we don't pass it now, once we get in, once the new council gets in and looks at it and has the numbers, or waiting until 2027 to adopt it.
Well,
Right.
right, you just look at, just like he said, you know,
Yeah.
I mean, just look at it all and maybe make some overall complete changes to this here. Yeah, I mean,
Yeah,
good, good changes.
yeah.
I mean, to me, the 10-year thing is, that definitely needs to be changed.
Absolutely.
Is the city's contribution a percentage of payroll? It's just a flat percentage, it goes, so every bit of payroll to the retirement goes a percentage?
They gave me a percentage of combined payroll, and that's in the study that we shared with you guys. I think it's somewhere around just shy of 13%, if I remember correctly. But they did not give me enough of the methodology to be able to break it down. That's something we would want to do moving forward, to be able to properly allocate for that. So again, I was just trying to make something work with what I had.
Okay. Do we have any other questions? So as far as the consideration for adoption of the amendment, amending the city's Blue Ridge municipal plan, do we need to vote on that tonight to not move forward with it and remove it from the budget if that's what they want, or how do we need to we've got it scheduled for a second reading the next meeting.
So, it is planned for a second reading, so tonight was just a first reading. You can decide to move it forward for a second reading or not. Mayor, you set the agenda, that's within, your discretion. I would tell you that there's, if you're gonna adopt a fiscal year 26 budget on Tuesday, if that is your intention or your goal, then I basically need to give this to you in a packet tonight. It's Friday night, I need to hand this to you in a packet. Even though the dollars are there, if you don't adopt the amendment, then the amendment does not take place, okay? And so you would be overfunded, as
Okay, so
Councilman
they
Lake
could do an
has
amendment.
pointed out, and that would be an amendment that would reduce your expenditures moving forward.
Okay.
But you could leave them in there for purposes of Tuesday's vote, because it only takes effect if you both fund it in the budget and you pass that
Okay.
plan amendment, that ordinance document.
Okay.
You'd have to do both, okay? If you did not pass it, the plan amendment itself on the second vote, you would just know there would be an opportunity to reduce your retirement expenditures moving forward.
Well, I say, let's just keep it on then, and then, it's on the amendment. If someone wants to remove it, they can with an
Okay.
amendment to the agenda, or we vote on it Tuesday and they can vote for it or against it. We have two members who are not here. I will not speak for them on how they feel because I really don't know, so, but that would give them the opportunity as well, so. Okay, is that good with everybody? Okay, it is 10 till. No, if there are no more questions, then meeting is adjourned. And thank you, Mandy, you did a great job.
Thank you.
Oh, I do have one thing. They're doing Wreaths Across America tomorrow at 11 o'clock at the middle school. For anybody who wants to help put out wreaths for the veterans, it's the first